The Securities and Exchange Commission voted to end a longtime staple of the investment industry today, the fixed $1 share price for money market mutual funds, in order to keep that $2.3 trillion market safe in the event of another financial crisis. Hampton Pearson joins us now from Washington with more. Hampton, what exactly did the SEC do today?
Pretty interesting day at the SEC. By a 3-2 vote, the Commission approved two major reforms aimed at preventing runs on money market funds. In plain English, first, the SEC will require the price of institutional prime funds to float, meaning investors could lose principal if values of the shares fall below $1 per share. The other big change, giving money market fund boards the ability to suspend redemptions temporarily if assets fall below a certain threshold. The two new regulatory tools designed to deal with what happened during the 2008 financial crisis, which of course has been the game changer for regulators. The Lehman Brothers collapse in particular triggered the failure of the reserve primary funds, which broke the buck with the value of shares falling below $1. The next week, investors pulled some $300 billion from prime money funds, 14% of total assets. And it was that experience that's really been the catalyst behind the six-year battle for the regulatory reform we saw enacted today.
You used a very important word in describing the money market funds that are affected here, institutional funds. What does that mean? And does that mean that the, quote, retail fund that I might invest in doesn't fall under these new rules?
Well, again, as you mentioned, it depends on what class of investors we're talking about. Not much impact for individuals. The primary focus, as we were just talking about, institutional funds. As for businesses that use money markets to manage their cash, the U.S. Chamber of Commerce saying today the new rules would increase costs for them. Those regulations, by the way, take effect in 2 years.
All right, Hampton, thank you very much. Hampton Pearson reporting in Washington.